China, one of the things that really stands out is different. I think you tend to find the group over the investor. Many investors are saying, when is China going to announce a big stimulus? The savings rate is really high. We don't think that's going to happen. Actually, we think that as long as the economy is growing around 5%, you're going to see more and more of a focus on next generation technologies, renewables, autonomous. Today, over 50% of all vehicles sold in China are EV in nature. Energy storage systems, battery technologies, these are some of the leading companies globally. You go to the Middle East, you're seeing a very healthy competition between the UAE and Saudi Arabia to transform their economies. So what I would describe is that this is the backdrop it's no longer a unipolar world. It's all about complexity. But as an investor, that actually is starting to create real opportunities for great risk-adjusted rewards.
Absolutely, and I think the very interesting point on top of that is when you're talking about these credit cycles and how we're not seeing that sort of, or what the meaning of that credit cycle coming in could be. We're today looking at 75% of emerging markets expecting rate cuts in the next year. I know there's an expectation of rate cuts in the US. So Claudia, I'd love to get your perspective on this as well. When you're expecting such en masse rate cuts, what does that mean for the opportunities in emerging markets, and how does it affect the policy, or how does it affect you as an investor in fixed income?
Thank you, Khaled, and thanks for the opportunity to be here. It's a pleasure. I am a portfolio manager at Invesco, mainly emerging markets debt, fixed income, in cross asset classes in the sense of local markets, hard currency. The rates and the FX decisions are separate. And I think it just first, if I may, a reaction to what my colleagues here were saying. It's very interesting to me that actually, the U.S. policy has been like a big driver this year, right? For us to think about how we can invest and driving this issue of the shifting trade patterns, investment patterns, as both Joyce and Alberto were mentioning. But it hasn't, so the impact of that in terms of stagflation outcomes or scenarios has not been exactly to the, or yet, to the extent that it was anticipated, right? And that's driving a lot of market optimism and very interesting, I think, valuations as well. And then it stands up the fact that EM resilience in emerging markets has been quite remarkable in this environment, right? So again, we're in an environment where there's a lot of policy uncertainty, which is hard to price. We're used to dealing with risks, but much less used to actually being able to price uncertainty under different outcomes. Yet emerging markets resilience in terms of the macro economics and in terms of market performance is a standout, right? And that's quite interesting to thinking about the short-term momentum and some of these more long-term structural issues that Alberto was also mentioning, right? Now, in terms of rate cuts and emerging markets doing rate cuts, right? I think the first thing that we have to admit is that there are certainly domestic drivers, and emerging markets are in a much better domestic equilibrium, macroeconomic equilibrium, to have some independence from the Fed and be able to optimize their business cycle and enact their mandate, right? How to conduct monetary policy in a way that you do have sustainable growth, that you have low inflation at the least output cost. At the same time, I have to say that Fed policy does cast a long shadow in this process. So we do think that there are some global drivers out there that are very important for central banks trying to understand or try to put together with their domestic circumstances how to enact conduct monetary policy. They do have a lot of room to cut, but you know, the issue of Fed policy and the weakness in the US dollar is very, very important for emerging markets across asset classes, right? So that's a little bit of a big question there. We had a cycle of the US dollar in a real effective exchange rate terms that for the last 15 years has been, you know, quite strong. And so now we're seeing the tip of that turning around, and there's a question mark out there how we're going to continue on which path we're going to go. But that's been very, very supportive for EM and for central banks as well, because it helps on the inflation, it helps on their exchange rate depreciation risk that they usually, you know, in emerging markets, it's usually a constraint in monetary policy. So there's definitely more autonomy right now, and I think more room to cut. But lastly, I'll finish with this. One thing that is not surprising in EM is that there is a lot of divergence. There's always a lot of divergence across countries, across regions. And so when we're talking about rate cuts, you know, there are those that have more room, there are those that have less room, even if their real policy rates, you know, are very, very high, which is the case in some countries, notably in Latin America. Brazil has very high real interest rates, Colombia as well, even Mexico to some extent, right? Although they are now finding the room to cut rates. And spreads, Mexico versus US, are really at you know, very compressed. So it's all very interesting. So I think bottom line, without going into specific stories, a lot of divergence. In general, EM's in a much better shape, and opportunities to invest. I'd agree with my colleague there, both on the equity side, on the EM debt side, especially local markets.
Just very briefly, just 1 minute, I totally agree. I'm not so sure we have a lot of room to cut. You know, I think Claudia's point is right on, you know, on the spot, that there's a lot of heterogeneity. Some countries have less room to cut because they're already at neutral. Some have more room to cut because the policy is still restrictive. The ones that have a lot to cut, I think it's still conditional on a baseline of further Fed cuts, and that we continue on a global environment of a weak dollar, that this weak dollar trend will continue. That has certainly facilitated the normalization of monetary cycles, of easing monetary policy across the full spectrum of EM. But there is a very important point that Claudia touched, and I'm just going to take like just a minute on that. You know, is kind of this issue between risk versus uncertainty in the markets. As someone that has been in financial markets for quite a while, and you know, my colleagues as well, financial markets are not afraid of risk. That's the bread and butter, what we do every day. Risk is not a problem. We know how to price risk, we know how to mitigate risk, we know how to hedge risk, we know how to slice and sell it. And so that's not a problem at all. That's the essence of the business. Uncertainty, totally corrosive. We panic with uncertainty. We don't know what to do with uncertainty, right? You know, risk is not a problem. It's like, you know, if you tell me, you know, that, you know, I'm gonna leave home on January the 2nd, and tell me, oh, what you're gonna do it this morning. January the 2nd, you know, probably the temperature is gonna be around 32 to 28, and it may snow or rain. So if I don't know anything else, I know the distribution of the weather for such a day. Usually I, you know, leave home with a warm jacket and perhaps an umbrella. You know, that's, you know, I know the risk distribution of January 2nd. Now, if they tell me, Albert, you're going to leave home today, but we don't know if it's winter or summer, you know, the distribution of this, I don't know what to do. Shall I take a t-shirt or a warm jacket, right? So that kind of, you know, gives you in very, you know, clear terms that, you know, the uncertainty we've seen on a number of fronts, from the geopolitics, from the tariff regime, from protectionist policies, you know, all that can potentially be corrosive and eventually even generate headwinds to harvest the opportunities that Rohit mentioned.
Yeah, and I think a lot of this also comes from, to sort of follow up on the context of the declining rates, a lot of this comes from the context that in the United States there was very low interest rates for many years, I think around a decade in the 2010s. And through COVID, post-COVID 2021, we sort of see a large increase in rates. One of the larger, one of the more interesting phenomenon that we've started finding is, despite US markets overperforming and emerging markets on top of that overperforming, we then have this underlying sense that bankruptcies within the United States are still increasing. The number of companies that are actually struggling to maintain their procedures are actually increasing every year, despite markets reaching all-time highs. So, Francesco, amongst the sort of credit landscape, and when we're seeing a lot of these companies actually struggling, what does that tell us about the underlying economic health of the US, and are emerging markets in that same sort of space?
How much time do you have? Look, it's really interesting because in the U.S., even in aggressive bull markets, and I'd argue we've been in a bull market since 2008 or post-2008, except for COVID, there's a little of a blip there. There's always companies that run into trouble and ultimately either file for bankruptcy or take other measures, shore up liquidity, extend maturities, etc. So I'll compare US versus EM for a second, because I think in the US, there's been so much third-party capital raised, mostly private capital, whether it's credit, private equity, alternatives, etc., that the real default rate, and Joyce, correct me if I'm wrong here, but the real default rate is like around 2%, but if you factor in what we call liability management, that rate is probably closer to 20%. Liability management is simply extending maturities, usually with incremental capital to facilitate those transactions. So in the US, it's become very much a liability management market and fewer bankruptcies than historically. Now, what happens? Ultimately, 2 or 3 years, those maturities could wind up in a bankruptcy scenario, so it's like, well, why not just fast forward to the main event and just go to the bankruptcy and clean up the capital structure and things like that. But I think for now, just given the comfort of investors investing in the US, tons of capital chase these deals to the point where investors in the same capital structure are competing against each other to put capital to work. Contrast that with all of the cases I'm working on in Latin America, in Brazil, Mexico, Peru, Colombia. Most of those cases are going through court processes, local court processes, in some cases Chapter 11 in the US for a number of strategic reasons. For the most part, the companies we're talking to have tried to pull whatever levers internally to deal with, trade imbalances and tariffs and what's going to happen with rates. And for the most part, they're doing a good job. We haven't felt massive impacts from any of that. The cases I'm working on in Latin America all have idiosyncratic issues. Nothing to do with tariffs or anything like that. They're all, project financing that went sideways or cases like that. And then last year I remember speaking, and I brought up a certain concern of mine, which has played out, unfortunately, in a couple of cases, which is fraud. And as much as you can price, January 2nd risk, you can't really price fraud. There's a couple of cases that you can look them up, I won't go into the names, but like where cash was supposed to be in banks, and the cash isn't there. So like what happened? And these are big, sophisticated corporates, and so investors, like in a case like that, secondary trading levels in the bonds will drop, and they did 60 points over the course of 2 days. So bonds that were trading at par basically dropped to 40 in 48 hours. So the point is, like, there's a lot going on in terms of, it just feels like very frothy to me from a macro perspective. It feels a lot to me like 2005, 6, and 7, that big LBO boom before the GFC. That said, there's a lot of capital to buffer potential bumps in the night, as they say. But the takeaway, I think, is even in roaring bull markets with equities at all-time highs, there's always restructuring kind of work to do, or companies have overextended their balance sheets, have not really thought about sort of 3 years from now. They're just kind of like trying to fight to live another quarter in some cases, or another year. We're keeping a close eye because of the whole rate situation in Brazil. I think a lot of those companies, if rates don't go the other way, I think are going to wind up in some kind of process.
Yeah, and Joyce, I'd love for you to also build on top of this is, when we are trying to navigate this sort of, or maybe this sort of disconnect between equities markets doing extremely, extremely well, like Francesco mentioned in 2006, 7, 8, how do you then, as an investor, navigate whether or not you should be in that bull market and be participating and being very risk on, or whether or not these underlying macro factors are actually more of a concern than the equity market is internalizing?
Yeah. So what we are seeing is, if you look at the developed markets, sort of a disconnect between looking at what's happening with bond yields and what's happening with the equity market. Because there's more of a long-term focus on the fiscal debt and the debt sustainability. And that's showing up in, we've seen term premium in the US rise 150 basis points, this whole argument that we're actually at neutral rates now, there's not much room for the Fed to cut. So I think you are getting these long-term signals that are warning of some of the risk ahead with respect to the fiscal and the debt sustainability. And I think emerging markets are not in as dangerous a place that way. The deficits are higher than they were before the pandemic, but really from the first Trump administration, developed countries sort of blew out the fiscal deficit and the debt dynamics in 2017. So, but I think your question, the markets have rallied so much, everything looks like it's so fully priced right now. How are we looking at asset bubbles? The problem is that the inflection point is very hard to call. So you can look at 2026 and say, where we are in the AI investment cycle, it looks pretty clear that you're going to have a lot of CapEx going in. But then there's a whole question of when will we actually see the productivity gains? When will we actually see the return on investment? And you're even seeing just the intraday volatility with money so easily available, because it's not just that capital is available, it's customizable now. You can go to the private markets, there's the rise of the digital assets. And that's why I do think that in emerging markets, because you had 4 years of outflows, you have more competitive currencies, you have sort of still high interest rates in many countries, there are more opportunities, but you have to be pretty selective here. And so some of the themes that we look at are not even so much on countries or regions. I agree the market has changed. It's been like who is set up in some of the areas where we think there is growth and innovation, like the payment system. We're looking at the data centers. We're looking specifically at the sectors where we think that they are a bit more insulated from some of the market volatility and have inflows that we can actually track coming in. Because if you can't track the productivity, you still can track the actual business investment that's going in. I think that we have also seen that if you look at where emerging markets have been positioned, still most investors are still underweight unless they're dedicated investors. So I actually think this is a moment for emerging markets that is going to continue to attract a lot of interest, even though you need to be selective here.
Hey, Alex, maybe I could add
Of course.
a point to Joyce's. So up until about 6 months ago, as an equity investor, in a forum like this, I would be looking...
Brilliant. Try the microphone a bit higher.
Oh. Sorry about that. I was going to say, that about 6 months ago, in a forum like this, I would be looking for the exit. People would come to us and say, why do I need to bother with emerging markets? I'm getting 15% over the last 10 years in US equities. Emerging markets have given me less than 5%. And I think what's important is sort of understanding where we are today in terms of that discussion around valuation. So emerging markets today represents less than 10% of global market capitalizations. The United States is around 70%. On top of that, you think about where the starting point is around valuations themselves. So EM today, on average, and again, this is why on average is also very dangerous, trades at about a 30% discount. The other thing that's I think is important is that if you think about the level of narrowness of the markets, emerging markets is not just an AI opportunity set. You do see sort of the opportunities in financials and the deepening of the asset class. It's definitely not what it was 20 years ago when it was heavily materials and commodity centric, but you are seeing that natural evolution. I do think that today, from a risk-reward context, understanding some of the comments from our colleagues, what has historically been a big headwind for emerging markets, which is strong dollar, is turning to be a little bit more of a tailwind. But ultimately, good governance, understanding company balance sheets, understanding that risk reward is, you still need to do that work. And there, as an active manager, we see a lot of really exciting businesses to invest in.
Yeah, maybe I can say something as well. It's working. Just because Joyce was mentioning the opportunity set for EM, right, and these differences in how flows are being driven. The issue of selective inflows or selective investment, right, and this divergence that we always see in emerging markets. What's essential, I think, these days, and very interesting to me, from as a trained macroeconomist, the idea of credible policy frameworks that we are seeing. So it's not just a business cycle improvement in emerging markets, but there are some stories out there that could have structural components, and that's really very, very exciting, right? And just to leave Latin America for a second, I would highlight, for example, the changes going on in South Africa, for example, where there's a new coalition government, that hasn't happened in decades, where there is important reforms on the electricity sector, which is very constrained, logistics. So as is the case with EM, I mean, we always have to see how structural things are, but they are moving in that direction. There's a good story to tell, and that's really very interesting. And assets respond to that, right? So we see the performance. Nigeria is another one, right, where also we see a very different type of fiscal and monetary policy with a very good technical team, at least, so etc. So I just wanted to make this point, to bring that up. Thanks.
And I think
Argentina. Yes, I was leaving Argentina, but we do spend a lot of time in Argentina. Yes.
I think to sort of close on our panel, I think the main point that is common throughout all of our speakers today is that emerging markets have always been and still will always have opportunities. The question is now less about these generalized themes of a specific region or generalized themes of whatever type of country, and more on a case-by-case basis. It's not just that Latin America is going to have decreasing rates, therefore run into Latin America. It's what about Brazil's situation or Argentina's situation poses an interesting example. So with that being said, I think I'll have to close on our panel today, but thank you very much, all of our speakers.
Present our keynote fireside chat, Latin America and the New Global Playbook, moderated by Dean Caroli. Thank you so much.
Good morning. Can you hear me? There's no microphone working. Mine is not working? Now it is. Now it is. Good morning, everyone. And thank you very much for the call back. You know how this works. Andrew Caroli, the Charles Field Knight Dean of the Cornell S.C. Johnson College of Business. I am so pleased and proud to be here together with you all. 15 years, right here, 15 years. Many of you may not realize, but, and I just reminded Alberto Ramos from Goldman that he was there for the very first one. There were 35 people on the 4th floor of the Cornell Club in Midtown, and 35 of us gathered. Why don't you just take a look around and check out how things have changed here. This is absolutely remarkable, and we're so proud to have you all here. Today, we've had a great start here. I am so fortunate to have joining me on this topic. The topic for us here is Latin America and the New Global Playbook. We've had a number of references to Latin America already this morning. I'm the moderator. We have former president of Colombia, Ivan Duque, who would have been here. I don't know if you can see him. Yeah. Can you hear us, Ivan?
Yes, I can.
All right.
It's a pleasure to be here.
Right. Unfortunately, or fortunately, he is in Belém this morning at COP30, and he's going to be reporting back to us on what he is hearing and learning there. I'm also very grateful to have here sitting with me Alfonso Eizaguirre, CEO of LATAM. Thank you. LATAM and Canada for JP Morgan, as well as Dr. William Maloney, Bill, who is the chief economist for LATAM and the Caribbean for the World Bank. And what an awesome fireside chat. There's no fireplace, but we can still have the chat. And so why don't we just get right into it and just talk about, we can reflect on what we heard in the previous panel, but we can maybe go straight to the opportunities that are there for the region in Latin America, and thinking about sort of the economic landscape as well as the landscape for businesses in Latin America. At a very high level. So President Duque, would you mind launching us off here and starting us off?
Well, thank you so much, Dean Caroli. It's such a pleasure for me to be here. I really missed not being there in person, but as you know, I'm here participating in COP30 in the Global Biodiversity Alliance. I also want to express my admiration for Alfonso and also to Bill Maloney. I know how much they have worked in Latin America, so I have big respect for them. So when we talk about opportunities and also challenges, Dean Caroli, I just want to mention 3 of the ones that keep me awake. The first one is intra-regional trade. Intra-regional trade in LATAM is not above 15%, which is one of the lowest intra-regional trade percentages around the globe when we look at certain areas like Europe or Asia. So it is a challenge, but at the same time it is an opportunity. If Latin America gets to expand intra-regional trade, I think we will reduce our dependence on trade with other parts of the world, but at the same time we will be creating stronger aggregated value chains, regionally speaking. The second challenge and opportunity has to do with arable land and the possibility for LATAM to be a bigger player when it comes to food security, not only in the Western Hemisphere, but also around the globe. So we have one of the largest shares of arable land in the world, with great access to water, with also prominent levels of productivity per hectare. So we have to be not only industrializing and being more clever in increasing the productivity levels, but also how we insert to other markets. And the third has to do also with what it has been seen as an opportunity in terms of the age of our population, which is a demographic plus that we have. As we are having this conversation, almost 73% of the Latin American population is below 45 years old, which means that we have a demographic bonus. And we have to be clever enough not only to expand the middle class, but to be able to formalize that labor force. So it is an opportunity now, but it will also be a challenge in less than 2 decades. Why? Because the population above 65 is going to triple in the region. So that means this is going to have more pressure on fiscal expenses in Social Security and healthcare. So we have to use the opportunity now to insert ourselves in aggregated value chains where the labor market and the skills can be fundamental and play an important role, but at the same time, we have to guarantee that the labor force is formal enough so that we won't have people left behind when it comes to access to Social Security access 2 or 3 decades from now. So I will stop there in order to hear what Alfonso and William have to say about this, but I would say those are 3 opportunities and challenges that we must focus on right now.
Thank you, Ivan. We're going to come back to the challenges in a second, but I hear a very optimistic tone in your assessment, in your size up there. And I should have mentioned, remiss of me to mention that President Duque is the inaugural EMI Distinguished Fellow, and we celebrate that and are very grateful for that. So, Alfonso, let's turn to you. You know, sort of a general optimistic size up there in terms of the economic and business landscape. Go.
I'm going to be even more optimistic than President Duque, and I complement 2 advantages that he mentioned, or 2 pillars. The first one, on the natural resources, I agree 100% with him. He mentioned land and water. Actually, Latin America holds 30% of the freshwater reserves globally, and 25% of the arable and forestry land in the world. So that's a huge asset. We generate in the region 16% of the net global exports of food. This is protein, animal protein, agricultural products. So it's a huge pillar. I agree 100% with what he said. In terms of demographics, I agree 100% as well. We have a population of 660 million people in the region. It's 8 years, the median age is 8 years lower than in the US. That's a huge, and even more than in Europe. Our population will peak in 2055. So this is an asset, and it's an asset from when you think about Latin America as a market. I mean, multinationals think on Latin America as a market where we can deploy investments as a consumer market, but also for nearshoring. So the labor available in Latin America, because of the reason President Duque mentioned, is going to be available for a very long time. There are challenges, I agree. And that list is very long, and we always focus on the challenges. So let's focus for 1 second on the pillars. Then the other one is the role we play in energy and energy transition. Latin America holds 20% of the proven oil reserves. Nobody talks about this, but we also hold vast reserves of all the critical minerals that are required for energy transition. I'm talking about copper, lithium, nickel, cobalt, etc., etc. Chile and Peru are the largest producers of copper globally, and then there is a triangle, Argentina, Bolivia, and Chile, that hold, I think it's 50% of the lithium reserves in the world. So this is important, very important. And then there are 2 topics that I always mention. One is the proximity, the geographic proximity to the US. This is not a minor thing. We share 3,500 kilometers of border with Mexico. That's an asset when you think about nearshoring, but we also share the same time zone. And that's an asset when you think about exporting services into the US. And you know, one example is us, JP Morgan. We have 4,000 people in Buenos Aires. We have lawyers, coders, and they serve the world okay, but JP Morgan globally, but they serve the US as well.
Yeah.
So that's a huge opportunity. Costa Rica is another case where we know several multinationals have established operations to serve the US. And I mentioned just one last topic. There are many countries, not all of them, that have a clean energy matrix. And we have heard a lot about, digital infrastructure, data centers. Okay, those markets where you have clean energy matrix, a clean energy matrix and good connectivity are great for that purpose.
That's great. That's great. Very, very nice size up. Bill, you contribute importantly to the World Development Report of the World Bank on LATAM. You give a perspective, high-level economic prospects for business.
Well, so let me first second what Alfonso and President Duque say about the potential that the region has in terms of endowments and where it could fit into the global value chains going forward. In particular, this bit, the energy matrix in Latin America is the greenest on the planet. So something like 50% of electricity is generated from renewables. If the European Union takes their carbon border adjustment mechanism seriously and tariffs carbon-intensive products coming in, then Latin America, in theory, could be very well positioned to export a variety of product manufacturers, but also processed agro and like to that market. I would also say that 3 years ago we wrote a report that was very bullish on the potential for nearshoring. At that time, Secretary of the Treasury Janet Yellen had said, "Listen, we've got all this nearshoring potential, blah 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 blah." That's already been obviously been shaken up a bit in the last couple months. But part of what Joyce was saying, I think, is true. There are two in the sense that these tariffs have bitten much less on Latin America than we expected, both in Mexico. Most, even goods that could be considered under the USMCA have been grandfathered in, even if they're not formally part of it, and so they're exempt from taxes. So the overall tariff level on Mexico has been kept relatively low, and Brazil, as was mentioned earlier, 47–48% are exempt, and the rest are pretty well integrated. The coffee and the like are pretty well integrated in the global market. There's this competing imperative right now that Joyce kind of laid out. One is this desire to bring industry back to the United States, and then all the traditional critiques of NAFTA are still out there. But the other is this allergy to China, and this idea, this new economic Monroe Doctrine that Bessem talked about. And I think the latter is going to win in the end, and so the cards are going to fall in favor of integrating the region more with the United States economy. And I think the very fact that the tariffs on Mexico have been so small relative to what was to the noise around them reflects precisely the American business community has been very successful in saying, for our competition globally, we need to keep this model going of having Mexico as our backyard. Now, let me be the bummer in the room.
I'm coming to the bummer part in a second.
Okay,
go ahead.
so
you want to start? You want to tee us off?
Sure. Unless President Duque wants to go ahead, but
well, we're going to get to the hard questions right now. So there's a lot of optimism in that tone. We start with that purposefully, Bill. And what we'd like to do is now talk about the fact. Well, 10 years ago, I wrote this book called "Cracking the Emerging Markets Enigma." A copy's out there if you want to go get one. First sentence in defining what an emerging market is talks about the importance of underfunded, undercapitalized growth opportunities stemming from problems. And the problems are really what define them. They can be structural in nature, but there can be other forms as well. And so we should really talk about these key risks, particularly salient to Latin America. Ivan, you started us off with that. You warned us you're coming with that. You painted a very positive picture. Let's go straight to the heart of it, if you don't mind.
Well, I think when we look at the biggest challenges, I would maybe list around 4 or 5 that are the ones that I consider the most complicated to deal with. One is that I see growing levels of debt in Latin America. So we're seeing debt levels on average being above 55–60% Now their country is getting to 70%, and obviously in the Caribbean it looks pretty bad. I mean, in comparison to other recent times. So debt levels for me are something that are quite complicated and also are rising on fiscal deficits. And the reason why I'm worried about this is because there's a lot of budgetary and unflexible expenses. So high levels of debt, not too much flexibility, and investment percentage of budgets being reduced severely. So that, for me, is worrying because that can take us easily to another lost decade unless we're able to bring a lot of private investment that is able to compensate those limited fiscal spaces that countries have. So that's one. The second has to do with regulation volatility. The fact that we have seen so many populist regimes coming in or out are challenging because it hurts long-term investment. And investors want to have predictable government behaviors when it comes to regulation in the energy sector, in the infrastructure sector, also in capital markets, banking, you name it. So I think regulatory volatility is something that is making sometimes Latin American countries be less attractive when it comes to bringing new sources of investment. The third challenge that I see with some levels of complexity have to do with this idea of having new protectionism measures or policies. So it's protectionism, isolationism, and authoritarianism. Those three at the same time, those isms are for me three big challenges that I would put just in one spectrum. And I would say the other two are related to insecurity levels, where yes, we've seen successful stories in countries like Colombia in the last decade, although we still have many challenges to deal with, Salvador, but what's going on in Ecuador, even in Peru with very low homicide rates, the level of insecurity is increasing. The same thing in Argentina, because now we have transnational criminals being stronger and stronger. So this requires a lot of coordination. And last but not least, has to do with the risk of missing the technology boom that AI is going to create around the world. And this has to do with public education is still very weak, very highly captured by professor unions, and they're not adapting the educational system to the demands that are going to be needed in the upcoming years. And obviously, when you look also at the possibility of being Latin America hub for data centers, because as Bob spoke, yes, we do have a lot of energy, we have excess energy, clean energy, but for many of the companies, Latin America is not in the primary list where they want to have their data centers, and I think that would be a lost opportunity. So I would say those are the 5 risks. I think they can all be addressed, they can all be tackled, but I see those 5 risks as obstacles that if we're not clever enough how to deal with them, I think they will become anchors and will affect their possibility to have a stronger growth in the years to come.
Excellent. Nice size up. Bill, we'll take you next. You were ready to jump into this, so
yeah, sure.
Add to the list.
So let me, President Duque is kind of putting it, if we don't get these things together, then these things aren't going to happen. Well, the good things aren't going to happen. I want to be a little bit darker. I predict they're not going to happen. And let me be pessimistic in this way. The first thing is this opportunity for nearshoring. 5 years ago, with Trump 1 tariffs on China and the like, we did not see a big increase in capital flows to Latin America and fixed investment. We did not. It still continued to East Asia, more or less, and there's a reason for that. When you add up all the downsides of working in Latin America, from the security risks he's talking to, from the weak education system, 30% of firms in Latin America say they can't expand, including Chile, by the way, say they can't expand for lack of mano de obra calificada, for qualified workers. 30%. In Argentina, the PISA scores, of the top of the richest quintile of population are below those in Vietnam. Okay, we invest half in infrastructure of what Asia invests in infrastructure. We have this problem of organized crime, which is no joke. Okay, Ecuador right now is where Colombia was 30 years ago in terms of threats to the state, the integrity of the state, and we're seeing the penetration of organized crime in places like Chile and Uruguay, where we never saw them in the past, and they're not bigger. It's not one cartel in Cali or in Medellin. It's transnational cartels, which are much bigger than the power of any government. All of that is a worry. Now, let me put a longer term spin on this, which is that we grow at 2.5%. That's the worst in the region, in the world since COVID. And it's not a COVID thing. That is our steady state natural level of growth right now, and it's pathetic. Chile, which is the good student of economic policy, good microeconomic policy, the first to really get their macroeconomic house in order, which is great, by the way. No one's talking about Latin America as this hyperinflationary, uncertain region the way they did 30 years ago. That is under control, and that for the most part, and that's great. But we're not growing. They haven't had any productivity growth for about 10 to 20 years now, and that's a major preoccupation, and we don't know how to fix that. And I think those problems go very deep. They have precisely, getting back to this primary education thing, we're short on STEM graduates, we're short on technicals and technologicals, mid-level technical people, because we don't have community colleges. Our universities are low productivity. We have very few in the top in the world in terms of quality, and they are very poorly integrated with the private sector. So this kind of flow, this Silicon Valley model of collaboration, that's not there. Why is this important? Because we just put out a book called The Lost Century of Growth in Latin America, Reclaiming the Lost Century of Growth in Latin America. Why is it that we were not able to leverage the natural resources like copper, and now we're talking lithium. Why couldn't we leverage copper in Chile in the last century into a diversified economy? When the Japanese, who were the second largest exporters of copper, were able to do it. And you know 3 major Japanese copper companies, Sumitomo, Hitachi, and Fujitsu. You never think of them as copper companies, but they all started as copper companies, and yet somehow they developed, became more complex, and drove the economy. And that never happened anywhere in Latin America. And if you look at the number of engineers we had in 1900, the amount of literacy, it all comes down precisely to our inability as a region to use knowledge from abroad, apply it to our local production structures, and grow dynamically on top of it. That is my worry, that between those things that make it just hard to do business there, and our lack of ability to leverage both FDI and these critical minerals and our other advantages into more diversified growth, that we're still going to stay at this 2.5%.
So respectful disagreement is the Cornell way. And you have given us a chance here to talk about this from the perspective of Alphonse. You're JP Morgan, you're seeing vibrant financial activity all over the region.
After all of this discussion, I should exit.
No.
Let me give you some data. Okay, we have 7,000 people in Latin America. Okay, revenues of more than $4 billion. We manage assets for more than $300 billion. We have deposits from corporations for more than $50 billion. So we really believe in the region. I should be exiting the region. So let me give you, I add to the risks, but we are risk managers, and companies invest globally. We are a global player. We need to allocate capital and manage risk. And that's what every multinational does. Nestle, a bank, whatever, a power company. So I can add to the list, and I think I agree with most of the idiosyncratic risks that were mentioned. Crime and lack of stability. Let me add global risks, because this is a region that is open to the world. Okay, so you have trade uncertainty generated in this country. You have geopolitics that do affect Latin America. I mean, 3 countries, actually more than 3, I think 4 countries in the region, you might have the exact number, William, but the largest trade partner is China. So if this world becomes
all of them. All of them except Mexico.
Central America is not, but Brazil, Peru, Chile, and I think Argentina as well. Their largest partner is China. So in a world that becomes more binary, that might be a problem. Then we talk about that. I think President Duque mentioned the fiscal deficits of the Latin American countries. I think a larger problem is the fiscal deficit of the developed economies. That debt, I'm not sure is sustainable, and the knock-on effect will impact Latin America, okay? Because as he said, basically we have fiscal deficits and we rely on the international markets to finance those deficits. Then currency volatility associated with rates. All of that affects the region, but those are global risks that affect every economy, not only Latin America. And on top of that, you have the idiosyncratic risk that were already mentioned. I think it's not worth it.
This rings back to Joyce's presentation at the very beginning, where she talked about, I don't know if you call it Fed policy actions. She talked a lot about that, casting a long shadow, but that's part of the global thing. And she talked about how it's all about resilience in these emerging markets, and LATAM is obviously all of that as well, and hyper complexity she talked about. President Duque, thoughts on the sort of sober perspective that Bill shared?
Well, I think I agree with the comments that Bill made, and also with Alfonso. I think at the end of the day, we know the risks. We also know the potentials. But in fact, and I think there's a very interesting figure when you looked at Latin America trade partners 20 years ago or 25 years ago, when the century began. The U.S. was the #1 trading partner for almost 99% of the countries in Latin America and the Caribbean. When you look at the picture now, you can say that China has become a very interesting dominant player, because it is either #1 or #2 for 99% of the countries in the whole region. Now, when you look at the numbers also with the United States, well, the fact is that China over the last decade has been #1 or #2 trading partner almost all the time, maybe with the exception of 2023, where Mexico took the lead again. So that shows us that there is a high level of interdependence. And for Latin America to behave in this trade wars or permanent tension between United States and China is making countries behave like children of divorced parents in litigation, because countries don't know how to maneuver, how to move, what decisions to make. So if countries sign the Belt and Road Initiative, they'll be punished by the United States. Or if the countries become closer to the United States and maybe start embracing some relationships with Taiwan, they would also be having some kind of response from China. So that is a reality. But at the same time, I think there's something interesting, and it's that I don't like to see that prophecy that this tension is going to become a war, or is going to be something extremely negative just because there's a fact. When the Cold War was present, there was no interdependence from the US and the Soviet Union. Now there is a clear interdependence, not only of the US economy with China and the other way around, but it's actually, those are the two main engines of the world economy. So instead of talking about a new Cold War, I think I'd rather see it as a hot peace. So this is going to be a peace with a lot of tensions, but I think the interdependence and the need of having both engines of the global economy running is also going to be an opportunity. Now, there's something that I think Bill raised it, and Alfonso also mentioned it, and it has to do with investment in infrastructure. For me, and I saw it as president, I had a lot of questions from media outlets in the US saying that they were worried about China's investment in infrastructure projects in Latam. And I said, well, we want to bring investors from wherever they can come. But the fact is, in most of the bids of critical infrastructure projects, they're not US investors coming to Latin America. And I think Exim banks and DFC and the whole United States economic apparatus should see Latin America as an opportunity for rare materials, for energy, for infrastructure, data centers, and so on. So I think that should be also seen. But let me just also mention something about what Alfonso highlighted. Yes, we do have investors. And I think, for example, JP Morgan has been very active in LATAM. When you look at capital markets in the region, most of the capital markets in LATAM have been captured by fixed rate products that are essentially government debt. We haven't seen so many IPOs in the region. We haven't seen new players from the private sector come and offer new opportunities for people's savings to be invested in entrepreneurship, innovation. And I think that's something that we need to change, because most of the portfolio investors see the opportunities, but I've said most of the capital markets are captured by fixed rate, and we need to have more variable rates, which are connected with innovation opportunities and entrepreneurship. But what is happening is that most of those entrepreneurs are willing to go to the US, to NASDAQ, or to Wall Street to have their IPOs and not seeing the region as an opportunity. So I think that's something that we should be also pretty much worried.
Beautiful, beautiful. You're teeing up the last segment. We have only a few minutes left, but I want to move to the prescription part of the part of our conversation, which is what kind of, if it really is about turning investor sentiment stateside or anywhere around the world towards LATAM, notwithstanding these challenges, what kind of structural changes and what kind of appetite is there for that kind of structural change that is needed to turn those sentiments positively towards the region, even more so than is right now. So Bill, I don't know if you think about this stuff all the time at the World Bank. It's an important part of your mandate. So structural changes that you think are critical.
So first let me reiterate the tremendous achievement the region has in managing macroeconomic volatility. Again, right now we've seen this professionalization of central banks and ministers of finance over the last 30 years that have made it so, for the most part, we were the region that was farthest ahead in terms of fighting the inflation of anywhere else in the world. Yeah. Far ahead of the US, okay? That sends a very good signal to markets. Yes, it's fragile in some places, in other places it's still lumping to Argentina. But nonetheless, pretty much everybody knows how to manage the macroeconomy now, and most people have the capacity to do it. That's very good. These other signals, like organized crime, they're out there. People see them. Some firms in Mexico are paying 7-8% of their revenues in security. Okay, that's a bummer. We need to send some other signals as well. We need to get that under control, and I think that's a decade-long problem at least. I think these other sorts of things, like we are open for business in a more organized way. And I'll give you an example just because I have a captive audience and President Duque. But for instance, the coffee axis in Colombia, right? Starting with Barranquilla and then going through good education, stable, very good infrastructure. You could pitch this region as an alternative to Mexico for nearshoring, right? But right now there's not a coherent selling of that particular region. There's a lot of noise around Colombia's reputation still. So we could do that. And then in other places we have to make these other very visible advances in terms of, we do have the skilled labor that you want. And we are working on these, on getting our ports in shape and the like. We have to signal harder that, when you leave China, don't go to Vietnam. Come to the same time zone, as Alfonso was saying. Come, and that's a lot of homework we have to do. But we need to do it and signal hard that we're doing it.
Okay. What would you prescribe? Your clients are undoubtedly asking you.
I talk to investors, multinationals, and financial investors all the time, and I think it's very simple. And we don't need to reinvent the wheel. Rule of law, number one. Easy, number one. Okay, and that's connected with what President Duque mentioned before. Stability of regulatory framework. Yeah. You need to have visibility. If rules of the game change every year, you have a problem. Yeah. Those two are very relevant. Sorry. The third is red tape. All of these countries, when you try to invest it's very difficult to get the permits. And I mean, I talked to presidents, to public sector officials, and they're all trying to harmonize the permitting between federal, state, and city. But it's very complicated. So projects they take forever, okay, and that makes projects unprofitable. So that's the third. And the fourth, it was mentioned by President Duque, is local capital markets. Because once you have the projects, you need to be able to finance them. Yeah. And you finance them with banks, local banks, and local capital markets. And international capital markets complement the financing when there is size. But the local capital markets, unfortunately, because of regulatory uncertainty, have dried out. So it's not that companies don't want to list, it's that investors don't have I give a few examples. In Colombia's one, they used to have a larger capital market, but because of regulatory uncertainty around the pension funds, it's very difficult to invest. Chile happened the same. Now we have a pension reform, there is more predictability, so you will see investors going more into stocks and less fixed income because you have more predictability. Peru, same thing. Yeah. I don't remember how many withdrawals the pension funds have had, so if you don't know as an investor whether you're going to have the funds or not, you may need to sell your shares in a week because the regulation will change. You don't invest in equities. You invest in deposits. So that's the problem. So as long as we develop the local capital markets, we can achieve more investment, plus the other three: rule of law, predictability of regulatory framework, and red tape. Those are the three. You don't need to reinvent the wheel.
You want to chip in, and then we'll go back to
our financial markets in the region are relatively thin. Compared to other regions. And there are a couple of reasons that seem like dumb stuff that we could do pretty easily, but Alfonso will tell me why it's hard. But for instance, resolution of legal contracts, disputes, right? In the United States, it's somewhere between 3 and 6 months to resolve them. In much of Latin America, it's 2 years. Same thing with insolvency procedures. Again, 3 to 6 months in the United States, 2 to 3 years in Latin America. That just makes people reluctant to bet on anything that's risky, and anything that okay. Also, the amount you get once you resolve it is a fraction of what you get in the United States. Those things, I don't know what the political economy of reform is, but it strikes me that those are no-brainers we have to fix, and they're also easy to signal that okay, we've got this under control now.
Yeah, the governance reforms are part of all of that as well. President Duque, we're going to give you the last word here. In the last few minutes, prescriptively, what kind of changes would you be advising leadership in various countries in Latin America with respect to trying to address these structural problems and these risks?
So let me, Dean Karonji, and also to Alfonso and Bill, to close my remarks by trying to put this in a context of optimism and also on the deep part of your question. So as you know, in most of my recent academic life, I've always been asked about Latin America. And we Latin Americans sometimes tend to be gloomy, and we don't celebrate success that easily, as Gabriel Garcia Marquez used to say. But there's a fact. I mean, if we looked at what has been going on in Latin America for the last 35 years, obviously with ups and downs, this have been the best 35 years of Latin American history in terms of economic growth, in terms of expansion of the middle class, in terms of security, social security coverage, in terms of education coverage, in terms of reducing deaths of recently born children, expanding life expectancy. So in most of the human development indicators, I think we've seen the best 35 years of Latin American history, and I think that has to be celebrated. And a lot of this, and I know this is going to be controversial, but a lot of this was reached because I think we embraced many things of the Washington Consensus for structural reforms obviously also addressing very important social security reforms that allowed us to protect those who are most in need in a very focalized way, and I think that's also to be celebrated. Nevertheless, I think we have to think about the challenge of having, again, a new generation of leaders that are reformers, no matter how unpopular those reforms are, as it happened in the 90s and part of the early 2000s. Because we've seen a new generation of populists in Latin America that don't want to embrace technocracy, that don't want to respect the market, and that are trying to play with decisions that can bring easy political wins, but putting in danger the credibility of the markets. So we have to see the protection of democracy and technocracy and making structural reforms as something that we should not leave behind. And I think it is a major success, and I'll close with the Incarochi, that in the last decade, we've seen more Latin American countries as members of the OECD as we have never seen before. Colombia got there, Costa Rica got there, we saw Chile was there, Mexico was there, and now we have at least 3 to 4 countries that are willing to enter the OECD, which I think is very important because that gives a lot of regulation certainty. So we have a lot to celebrate. We have to see the quality of our democracy, the quality of our institutions, and the persistence on structural reforms as something that we cannot leave behind. And I am very honored to see that the Cornell Emerging Market Institute has been putting a deep attention on this with professors like Lourdes Casanova, with your leadership, but also with the support of persons like Roberto Cañizales and Gail Cañizales. The fact that we're having this conversation is because we believe the opportunities are there. We know there's a story that is positive to be told, but we still have to focus on democracy, markets, and regulation and stability as the cornerstones, and then human capital, education, and how we are prepared for the new technology revolutions. So I think there's success to celebrate. We still have things to address, and we have to address it defending the quality of the state, the quality of regulation, and the quality of politics. So thank you so much, Tinkaroj.
Beautifully concluded. Please join me in thanking Bill Maloney, Alfonso Aguirre, and President Van Buchez. Thank you very much. And I'll hand it back to you guys. Thank you. That was great. Fast-paced conversation. That was great.
Thank you to our keynote speakers for that insightful discussion on how Latin America is navigating shifting trade rules, financial flows, and technological change. Before we move on, a few words from Manjo Thomas, Associate Dean of New York City Initiatives at Cornell Tech and the Sponchi Professor of Management and Marketing at the Cornell S.C. Johnson College of Business.
All right. Thank you. Well done, guys. Thank you. That was great.
Okay, what is this? Yeah? Manon, toma. What is this? He's here. So I haven't seen so happy to meet you.
Very good, Bill. Yeah? You think? Yeah. Oh my God, the world. Many years.
Okay, yeah.
Yeah, in Africa. Melissa.
Yeah.
He worked with Louis Fox.
Luis.
Yeah, he wrote a book with Louis Fox.
Oh, okay.
Called The Eradicate Poverty in Africa.
Okay, one.
Empower Women.
Okay, I probably know that book.
Yeah. She missed. He left 15 years ago.
I didn't see that. I want to check it.
I know.
Don't check again.
It's her baby. She works for us.
Probably just wait till the next.
Yes. Yeah. But you know what?
Hi everyone, can I say a few words before we give the awards to the winners today? My name is Manoj Thomas. I am a faculty here and I'm also the Associate Dean of New York City Initiative. I just want to say how apt is it to have this conference here on this campus. How many of you have been to Conatec before this? Okay, there are a bunch of people who are new. So I just want to tell you what this campus is about and how this event adds to this campus. So this was a revolutionary campus that was started 15 years ago, breaking boundaries, very much in line with the discussion that we've had just before this. How do we break the silos between technology, business, society, and we created this interdisciplinary campus, which was an aspiration to create a Stanford on the East Coast. And I think we've done that. And one part that we were missing is the global perspective. And that's where Lourdes comes in. She's been doing this for 15 years, and this is the 15th year. Let's give a big round of applause for that. I also want to thank Rob for all the support that he's been giving us. And I'm so impressed to see that so many of you have showed up here because this epitomizes the spirit of this campus. I was told that there were 1,500 students from around the globe participated in the pitch competition from 21 countries. And then finally, there are 2 of them who won, and the awards will be given out now. So let's have the announcement for the award.
Next, please welcome Claude Ishamian from Corning to announce the winners of the case and pitch competition.
I don't know who's the winner, right? I'm gonna figure it out now. So the winner, the Doco Kids Pitch Competition, is the Universidad Javeriana and Universidad de los Andes, Colombia.
sure the banker is going to like this so much. We'll see what he says.
Thank you.
Well, congratulations.
Thank you so much.
There we go. Oh, wow. I can hear my own voice. Well, thank you so much, Cornell and me, for this and the Mobius group. We're very excited, and for those that couldn't hear the pitch, in Doco Kids, we answer pediatric questions for all Latin America. We're starting from Colombia, and we're helping all those families that over the night, over the day, have thousands of questions. We're answering around 8,000 questions a month, with more than 450,000 questions answered through the date. We hope to expand this to all the world and all the emerging markets, as they all have a need for healthcare, more accessible healthcare. In a region where 94% of people have access to WhatsApp, which I'm sure many of you are texting there right now, the problem is not connectivity, is that healthcare is not reaching how people need to be reached. That's what we do in Doco Kids. We use technology behind the scenes to be extremely efficient. If someone wants to talk to us, I'm here all day in pink, colors of Doco Kids. If not, you can reach to me through LinkedIn. But again, thank you everybody for this. Thank you to everyone that listened to this, and thank you for my team supporting us back home, whom this couldn't be possible. Thank you.
Other than congratulating the team that won here, we started that with Corning. I represent Corning today, with Lourdes and the Emerging Market Institute about 5 years ago. I want to say that I've seen most of these projects over the years, and it's quite impressive to see that over 60 universities were part of it this year, so congratulations for making that. And the amount of ideas that came out of that, all of these cases over the years, is just tremendous. We love it. We want to see young talents coming with their ideas, because you're going to lead our company one day. You will. So keep doing it. Thank you.
Okay, thank you everyone. And also we had the case competition, which included over 1,400 participants from over 21 countries.
We have Mark Mobius, who will say a few words,
Okay,
who is
great.
sponsoring the...
Okay, great. And also over 80 schools. The third place from Ritsumeikan Asian Pacific University, Japan, onset to Mango 2. We start from them.
Congratulations. What a great honor. Huh? Well done. Well done. Congratulations.
Amazing. Just for those who were not there yesterday, this year's case was of the pharmaceutical industry in SA, and so we know how all of this happens with biovaccines. For the second place, all the way from IIM Indore, India, CAP DM team.
All right. Thank you.
Thank you very much. all the way from India, also from Beat School of Management, ambassadors of Quran.
I know, we met her yesterday. Congratulations. Great. Here's our camera.
Ready? 3, 2, 1, smile.
Congratulations.
Thank you very much. Get set for comments from Mark Moore.
Good morning, everyone. As a team that's made it to the finals for the second year in a row, and as a school that's 4 years old from an emerging economy, I think it's a huge privilege to be here in front of this August gathering to receive this award. Over the last 2 days, I've had the chance to experience such spirited conversations about what it means to be an emerging economy and how the politics of power has shifted to a way that we are able to acknowledge the good and the bad and the ugly. And I think it's a milestone achievement that this conference has been able to create over the last 15 years. And I see a huge future, huge and bright potential for this conference to go up and up from here. Hopefully I'll see some of you again next year, more of you next year, and hopefully we'll win it again next year. But congratulations to all the teams that participated.
Hello. Thank you everyone, and thank you Lourdes and everyone at the team to organize this competition. It was a fantastic time to prepare for it, and the problem statement was so well crafted and so detailed that all of us and the BIT school actually is very big on case competition. We love it, and we had so much time in researching and analyzing such a core-rooted problem which we at India also face, and the case really answered, or we wish to answer, what over the next 15 years can we solve for Africa, and in vaccines especially, of course. So the goal was that African Union wants to manufacture 60% vaccines within the continent, and Vaccine Co, which was the hypothetical company assigned to us, wanted to play a big role, important role in achieving this vision. And yeah, the talent, the finance bit of it stood out as the core challenges, which is limiting and is the limiting factors. And the uncertainty, of course, political uncertainty, call it, within each country was also one of the backdrops and the issues we had to conquer. But ultimately, it was a fantastic time. If anyone
No, I think we just wanted to add that I think some of the tech challenges that Africa faces, just the unique challenges on ground, just sort of figuring that out has been really interesting and humbling for us. And yeah, I think we had a fantastic time. Thank you so much.
Okay, I just wanted to say that we start in March deciding on the country, on the industry, and the company, and the challenge. And definitely vaccines in Africa and being self-sustained in vaccines is a tremendous goal, as you were saying, not only of Africa, but many other countries. This is a tremendous effort, both the pitch and the case competition. I wanted to congratulate Trisha, Joe, Regina, so many who have worked so hard for the pitch competition. Mark Mobius, who is online, is he? Mark? No? Is he there in the list? Okay. And also, the case competition that has become so big started, as Claude said, as a partnership with Corning. Corning is very integral part of the development of the case. And again, tremendous work by Zara, Emma, Deji, Fiorina, really, and all the judges. Please, the teams, the judges, could you please stand up and be recognized? We have here Andre and so many forward, so many, really great work. And of course, all the students from all over the world who have participated. We are going to change a little bit because Asian is taking over, and India in particular, so we are going to change the rules, sorry. And definitely congratulations, and also to the faculty. She came, remind me your name, please? Shezala sent me an email last year, so they came and they were not finalists. They were not among the 3 winners. And she told me, this year we will be. And guess what? So, really, the ambition, the hard work, the vision, the innovation is all here. So thank you very, very much. And also educational institutions that are improving thanks to the students and thanks to the faculty who worked very, very hard. So yeah, as in the previous panels was said, Bill said, you know, educational institutions. We say the educational institutions improving all over emerging markets, and here you see the talent. Thank you very much. Thank you. Looking forward to next one. Okay. Please show the video. We have a video from last year that Claude was interviewed. The students from last year was electrical vehicles, Vietnam, and the winners were a team from VinFast in Vietnam. So we have a very short video, and we are going to show. Please, Matt, the floor is yours. We have taken a picture. Yeah. Okay, please. I would ask also the judges here to take the picture, the group picture, all of you. Thank you. Yeah.
Play the video.
Daisy, Emma, Fiorina, Joe, please, all of us, come. Yeah, please.
I always knew Vietnam was growing. It has an explosive GDP growth. But going there and working with their very own, very first electric car company, it opened my eyes. I could really see how well this emerging market is really doing.
Two-thirds of the world's population live in emerging markets, and that's where much of today's economic growth and innovation is taking place. At the Emerging Markets Institute at Cornell University, we study these dynamic economies and prepare the next generation of global leaders to engage with them thoughtfully and effectively. Our students don't just learn about emerging markets, they engage with them directly. One example is Cornell EMI case competition, where students develop a different real-world case study every year. And last year was VinFast, Vietnam's premier electric car company.
Going to Vietnam was not only a cultural experience. I was able to see how the people we've met were really passionate about where they were, from the workers to the leadership, how they were all working together for the same vision of uplifting the electrical vehicle industry.
We went for 10 days and met with the executive who help us understand their problem and their goals.
Meeting with executives of global companies in class is one thing, but EMI gave me a chance to go to Vietnam, walk the factory floors, see them in action in their state-of-the-art facilities. I mean, it was an incredible experience. Once we came back, we continued to write the case. We stayed in touch with the VinFast team, and they really helped us craft this case the way we wanted it to be. This case was used in a case competition that 700 students from across the globe participated in.
Their ideas were presented to VinFast executives and helped inform the company's strategic decision. Experiences like these are transformational.
They prepare our students, whether returning to their home countries or going to a new one, to live with insight and impact.
This experience really made me realize that my work was not only impacting my community at Johnson, but really I could impact the world.
I have always been passionate about the auto industry. I love the fact that I got to see it from the inside. I plan to stay in touch with all the new connections that I've made across the globe.
In a changing world, the ability to work across cultures, solve real business challenges, and contribute meaningfully to international companies and communities isn't optional. It is essential. EMI fellows are those leaders.
So I plan to go back to Indonesia to bring my experience to help shape global and emerging market in Southeast Asia.
Thank you so much. With that, I'm happy to conclude the first part of our day in the 2025 EMI conference. With that, I invite everyone to go enjoy lunch in the lower center of the Bloomberg Center. And let's reconvene promptly at 12:20 so we can keep the day moving. Thank you so much. 12:50, excuse me.